Hello, in this lecture we're going to talk about a 1031 exchange with regard to real estate and how it could help a business. We will be able to explain what a typical 1031 exchange looks like with regard to real estate, list rules for an exchange, and give an example to see how the flow will go. As always, I want to seek advice from a professional when you're thinking about a 1031 exchange, especially with regard to real estate, given the fact that it is generally a bigger dollar amount type transaction and there is more complexity involved. What we'll do here is take a look at the idea, the picture of the transaction so we can see the pieces involved and see the relevant flow of what the transaction could look like, how it could be structured, which could help through the process. So what does a Section 1031 exchange look like? So when we look at a 1031 exchange, it is, of course, an exchange. And in terms of real estate, if we're looking at the transaction and we're going to say we are A over here, we have this property. We want to trade our property with B, who has similar property, and we, of course, would give our property to B. B would give their property to A. Why would we do this? What's the benefit of an exchange? It should defer the taxes. The way it would defer taxes, for example, if we had the 100,000 was the cost of our property, and the fair market value is 200,000. If we sold it for 200,000. We would have to recognize generally gain on that. If, on the other hand, we exchanged it here for another property that happened to be worth 200,000, then the 1031 exchange could take effect in that case, eliminating the tax and keeping the new property that we would then have over here on the books at the old property's cost or basis. That's the basic idea or concept of the 1031 exchange. Now you might be asking, why would the IRS permit that? Because it really is a transaction that happened here. A transaction happened, but the argument is that we're not in any real different place or situation, meaning we didn't actually get the cash. One, we might not even have the cash to pay the taxes on the gain of the 100,000 to the 200,000 because we basically just exchanged the property. And two, we're kind of in the same situation in that we still have the property, a different property, so we haven't actually realized the gain. So that's the argument kind of for why a 1031 exchange would be something that the Internal Revenue Service would. Now, one reason they're going to permit it is because it's really just a deferral. Now the new property is on the books at 100,000 when it's really worth 200,000, and that means when we do sell it later on in time, we will have to recognize that gain at some point in time if it sustains its value. Now you may see a problem with this, and the problem is, of course, going to be that if we want to buy this new property and sell this property, we may be able to find this property. Maybe B wants to sell the property to us, but maybe B doesn't want to buy our property. They may not be in the same situation. It's going to be difficult for us to find someone else that wants to have a 1031 exchange. It's hard enough just to find real estate out there that we want to buy just in the market. So notice that if we bought the property from B and we sold our property to somebody else, we're kind of in the same situation. It's just that we're gonna sell our property, get the 200,000, and then pay our 200,000 to B here for this property. We're still in kind of the same situation, although cash did change hands there. We'd have to make the sale before we can buy the new property. We got to sell it for the 200,000, take the 200,000, buy the new property. So you could still make the argument that it should still qualify for an exchange type purpose in that we're still in the same situation after the entire process is over if we sold our property and then purchased the new property. So the question is there some kind of way that we can set this up so that I could sell to someone else and then buy the property from someone else and it still be qualified as a 1031 exchange given the fact that we are still in pretty much the same situation from the standpoint of A as if we had exchanged the property. So let's look at how that would be set up. That is possible to be set up. The way it would be set up is we would have A here. We would introduce another person into the transaction, that person being a third-party intermediary. So this is someone that you really want to help you out to make this process happen. You want to have someone that really knows what they're doing if they're going to be acting as the third-party intermediary. And then you would give your property to a third-party intermediary. We can imagine how this flow would go. Then the third-party intermediary, acting as the agents of the process here, would sell the property to the buyer. So they're going to give your property to the buyer, so our property to the buyer. Then we get the cash to the third-party intermediary. Notice that we, the person that is facilitating the exchange, isn't really getting the cash in this case. It's going to the third-party intermediary, who then takes that cash and buys the new property from somebody else. And of course, the seller of the new property is going to give the new property to the third-party intermediary, and then the third-party intermediary gives that property to A. So A then is in the same situation as the original kind of swap exchange for the most part, in that they gave up their old property, they received the new property, and therefore they can just transfer over the basis in the new property through that transaction. Now you're going to probably see some problems in this, or some potential difficulties. One would be that the timing of the exchange is going to be a bit difficult. We're going to have to go through escrow, buying and selling real estate could have problems through the process. So we need to make sure that we are in accordance with any timing issue, because obviously we're going to have to sell this property. The third party intermediary is going to have to take that money, find the new property, and buy the new property within some kind of time frame. You also might be saying, hey, it's not very likely, or it's very possible that the two properties aren't equal in fair market value. So we could have situations where one property is not equal to the fair market value of the other property, and we're going to have cash that's going to have to be exchanged at that point in time. So for example, if we were selling this property and we wanted to buy other property that's worth more, then we're going to have to shore up the difference with something, probably cash. And that cash transaction could trigger some of the gain within the transaction. So that's going to be a complication that we'll have to look into. We can look into more of those types of transactions in terms of the portion of the gain that would happen in these types of transaction. The same type of ideas happen with the loan. What happens if one or the other takes on the loan, the mortgage, along with the property? So again, those types of things could trigger gain, and we have to take a look at those individually and see what happens in those types of transactions. So is real estate, all real estate, like-kind property under Section 1031 exchange? So you might be asking, well, what type of property would qualify for a Section 1031 exchange? And generally all real estate does qualify, meaning real estate that's not even very related to each other could still qualify because it's real estate as like-kind. So remember, when we think about the code section 1031, there's the terminology of like-kind property that could then be qualified for a like-kind exchange. And it's pretty broad in terms of the different types of real estate that could qualify as like-kind. The big thing that limits a lot of people, of course, is that it has to be property within a trade or business or held for investment. So the one thing that stands out, of course, that's not trade or business or held for investment is our personal residence. So if you're thinking about something in a like-kind exchange on the personal residence, then that's not generally something that could be qualified, because it has to be business related or investment related. If, on the other hand, it was rental property, then it's possible that it could qualify for the like-kind exchange type of treatment. Now you might be saying, well, what if this was my personal residence, and what if I moved out and rented it out for a few years and then traded it? Well, again, the IRS code, the intention is probably that from the time of the exchange it was business or investment or rental property. But that's a question that you'd want to ask a professional on that and see what that would be. And that normally it would be probably some kind of timing that it would have to be rental property would be maybe one of the tests to see whether it was rental property. And that's something you'd want to look into. Also realize that if it is your personal residence and you were thinking of selling the personal residence, there is an exemption involved in that already. You get an exemption of your personal residence. So that's something to keep in mind as well. You might also be thinking, what if the property that I'm exchanging, what if this was rental property, but the property we're exchanging for, we want to make that our personal residence? And again, I think the intention of the code is the idea that at the time of the exchange, we don't have the intention to make it our personal residence. However, how would you test that transaction? It probably would have to be something to do with timing. So the question would be, could we hold it as rental property after the exchange for a certain time period before it would then qualify as something that we can then transfer to personal residence? Again, those are types of things. That's a situation you'd want to ask somebody those questions. Those are interesting questions within the 1031 exchange with regard to real estate. Are there any timing requirements to complete the Section 1031 exchange? This is going to be one of the big issues, because remember that when we sell the property, we got to then buy the new property from somebody else, and that whole process could take time, and there's some pretty strict timing requirements. And this is one of the things you really want to get the intermediary in there, someone to help you to make sure to get this transaction done so that it's done within the requirements of the 1031 exchange. So The basic requirements are this: taxpayer must identify replacement like-kind property within 45 days of giving up their property. So if we gave up our property, we've got to at least identify the new property within 45 days. And again, this is a tight constraint because there could be problems with the whole 1031 exchange process. So you want to make sure that you have this process down. Then the like-kind property must be received within 180 days when the transaction transfers in a like-kind. So you got to identify in 45 days and actually receive it in 180 days. So that's kind of a picture of the way the like-kind exchange would work and how the intermediary would be in there facilitating the like-kind exchange. Of course, when we get more deep into the tax consequences, when we talk about properties that are not equal in value when we exchange them, then we're going to have to get into some ideas of what happens when cash trades hands and what happens when people assume mortgages, and those are topics that we can take up at a later time.